SCHG and QQQ are two of the most popular growth ETFs you can buy. At first glance, they look almost interchangeable. They own many of the same companies. They've both dramatically outperformed the S&P 500 over the last decade, and they're often recommended for exactly the same type of investor. But once you start digging into them, some really strange things show up. The fund with almost twice as many stocks is actually more concentrated in its biggest holdings. The more diversified fund fell farther in 3 of the last 4 major sell-offs. And the fund that actually screens for growth was beaten for most of the last 16 years by an index that doesn't screen for growth at all. So what's going on? In this video, we're going to break these 2 ETFs down from the ground up. We'll see how each index decides what belongs, what you actually own, and then backtest both funds by investing $500 every month through every major drawdown since 2010. This is a data-heavy episode, but I'm not going to bury you in the numbers. I'll keep the story moving and focus on the results that actually matter. The slides will carry the full tables and the extra details. So if you want to dig deeper, pause anywhere you see one and take your time with it. By the end, I think you'll see this isn't really a story about returns. It's a story about rules. Because once you understand the rules behind these 2 ETFs, the performance starts to make a whole lot more sense. Let's start with what these funds actually are. QQQ has been around the longest. It launched in March of 1999. It's managed by Invesco. It tracks the NASDAQ 100 index, and it charges an expense ratio of 0.18%. QQQM is essentially the same fund in a newer, lower-priced wrapper. It launched in October of 2020, tracks the exact same NASDAQ 100 index, and charges 0.15% instead. Because both funds follow the same index, I'll use QQQ throughout this video since it has more than 2 decades of performance history. SCHG launched in December 2009. It's managed by Schwab. Tracks the Dow Jones U.S. Large Cap Growth Total Stock Market Index and charges about 0.04% a year. Now, the fee difference between QQQM and SCHG sounds dramatic until you put real dollars in it. It's only 11 basis points. On a $10,000 investment, that's about $11 per year. The portfolios are different too. As of July 30th, 2026, QQQ holds 100 companies, while SCHG owns 193, almost twice as many. But here's the first surprise. Even though SCHG owns nearly twice as many stocks, it's actually more concentrated at the top. QQQ has about 45% of its assets invested in its top 10 largest holdings. SCHG has over 51%. So right from the beginning, one of the assumptions people make about these funds just doesn't hold up. More holdings doesn't automatically mean a more diversified portfolio where it matters most. These 2 funds may own many of the same companies, but they decide what belongs in completely different ways. The NASDAQ 100 starts with 3 basic questions. Is the company listed on the NASDAQ? Is it something other than a financial company? And is it one of the 100 largest companies that clears those first 2 tests? That's essentially the screen. Nobody at NASDAQ is looking at revenue growth, earnings growth, margins valuation, or whether the company fits anyone's definition of a growth stock. There is no growth test built into the NASDAQ 100, and there never has been. QQQ became known as a growth fund because many of the largest companies that chose to list on the NASDAQ also happen to become some of the fastest growing companies in the world. SCHG is built differently. Schwab does not choose the companies itself. The fund simply follows an index created by S&P Dow Jones. That index starts with 750 largest U.S. companies, regardless of whether they trade on the NASDAQ or the New York Stock Exchange. It then scores these companies using 6 factors: projected price to earnings, projected earnings growth, price to book, dividend yield, revenue growth over the previous 5 years, and earnings growth over the previous 5 years. 2 factors look forward, 2 measure where the company stands today, and 2 look backward at what the business has actually delivered. The companies that land on the growth side of that process become eligible for the index. That screen runs once a year in September, and the portfolio then holds what that September review selected until the next annual reconstitution. So one index is screening companies for growth. The other is screening them primarily by size, industry, and where their stock happens to trade. That can sound like a technical distinction until you see what the rules actually cause the fund to do. For example, in November 2025, Walmart announced that it was moving its stock listing from the New York Stock Exchange to the NASDAQ after 53 years on the NYSE. It began trading on the NASDAQ on December 9th. 6 weeks later, on January 20th, 2026, Walmart enters the NASDAQ 100 and replaced AstraZeneca. Analysts estimated that the NASDAQ 100 index funds would need to buy roughly $19 billion worth of Walmart shares. So nothing materially really happened to Walmart's business during those 6 weeks. Its stores did not change. Its earning profile did not suddenly change. Its growth rate did not suddenly change. The stock simply changed exchanges, and once it met the NASDAQ 100 rules, every fund tracking that index was required to own it. SCHG does not own Walmart at all. Its growth screen does not currently classify Walmart as a large cap growth company. So one fund bought it because of where the stock trades, and the other left it out because of what the underlying business looks like through its growth screen. And that rule works in the other direction too. QQQ cannot own a company listed on the New York Stock Exchange, no matter how quickly that company is growing. It also cannot own a financial company, no matter how large or successful it becomes. Now let's turn those index rules into the portfolios you actually own. I pulled Schwab's complete holdings file and checked every position against the current NASDAQ 100. About 67% of SCHG is invested in companies that also appear in the NASDAQ 100. That overlap comes from just 47 stocks, but those companies do most of the heavy lifting in both funds. That is why their performance lines can track each other so closely for so many years at a time. They may use completely different selection rules, but most of SCHG is still riding on many of the same companies driving QQQ. The remaining 33% of SCHG is spread across 146 other stocks, and this is where its broader growth screen begins to matter. Roughly 30% of SCHG is invested in companies QQQ cannot own. That includes Eli Lilly at over 3%, Visa at about 2.5%, MasterCard a little under 2%, and a much longer list of healthcare, industrial, media, and financial companies. Financial stocks alone make up over 8% of SCHG. In QQQ, that number is 0. Now run the comparison in the other direction. Of the 100 companies represented in the NASDAQ 100, SCHG does not own 56 of them. The biggest exclusion is Micron, which is QQQ's fourth largest position at over 4.5%. The rest include a wide range of semiconductor, technology, consumer, and communication companies from Intel and Cisco to Starbucks and Kraft Heinz. Those companies did not make the growth side of SCHG's latest annual screen. They are in QQQ because they are large, non-financial companies listed on the NASDAQ. So SCHG owns 93 more companies than QQQ, but most of those additional positions are individually very small. The majority sit below 0.5% of the portfolio. Both funds are still driven by many of the same giants at the top. And despite owning almost twice as many companies, SCHG actually has more of its portfolio concentrated in its largest 10 positions. So the meaningful difference is not simply how many stocks each fund owns. It is what each set of index rules allows inside the portfolio and what it permanently or temporarily leaves outside. All right, now let's stop talking about index rules and see what they actually did for an investor. Here's the test. Starting in the first week of January 2010, I invested $500 every month into each fund. Dividends were reinvested. There was no market timing, no adjustments, and no skipping contributions. Just 200 straight monthly investments for a total of $100,000 into each ETF. Let's start with the drawdowns. The first real stress test came during COVID. Both funds peaked on February 19th, 2020. Over the next month, QQQ fell 28.56%, while SCHG fell over 32%. The fund with 193 companies actually dropped almost 4 percentage points more than the one with just 100. Both recovered in exactly the same amount of time, 79 days from the bottom back to a new high. If you were dollar cost averaging that entire decline, simply meant another month of buying shares at lower prices. Then came 2022. This wasn't a one-month panic. It was a grinding bear market that lasted more than a year. QQQ peaked in late December 2021 and eventually fell 35.12%. SCHG peaked about 5 weeks earlier and fell about 34.58%. So on paper, SCHG wins by about a half a percentage point. But there's another piece of this story. QQQ bottomed on November 3rd, 2022. SCHG didn't bottom until January 5th, 2023, about 9 weeks later. From peak to full recovery, QQQ needed 716 days to make a new high. SCHG needed 759. So depending on which clock you use, either fund can claim a small victory. In practice, though, the investor experience was remarkably similar. The 2025 correction was even closer. QQQ fell about 22%, SCHG fell about 23%. They bottomed on the same day, April 8th, and both were making new highs again less than 3 months later. Then came this year's correction during the Iran conflict. QQQ declined 11%, SCHG fell a little over 14%. Looking across all four sell-offs, the bigger takeaway isn't that one fund consistently protected investors better. It's how similar the experience was. Despite SCHG owning nearly twice as many companies, its drawdowns and recovery times remained remarkably close to QQQ's. Sometimes SCHG fell slightly more, once it fell slightly less, but none of these differences were as large or consistent enough to establish a clear defensive advantage. In reality, diversification by company count did not translate into meaningfully better downside protection. Now let's zoom back out. Those 200 monthly contributions added up to $100,000 invested into each fund. By today, the QQQ portfolio had grown to $615,000. SCHG finished at $492,000. That's a difference of roughly $123,000, despite investing the exact same amount of money on the exact same schedule. Now, let's look at the ordinary days between those big market events. Across more than 4,100 trading days, on the days QQQ went up, QQQ gained an average of about 0.88%, and SCHG gained 0.79%. On the days QQQ went down, QQQ lost an average of 0.95%, and SCHG lost 0.86%. Finally, look at the calendar years. Across 17 years, SCHG outperformed QQQ only 3 times. It edged ahead in 2021, it edged ahead again in 2022, then it had a standout year in 2024, beating QQQ by more than 9 percentage points. But that advantage didn't continue. QQQ was back in front during 2025, and it's ahead again so far in 2026. Over the full 16 and a half years, QQQ compounded at 18.77% a year. SCHG compounded at 16.21% per year. Much of that gap came from where the two indexes were looking. QQQ's only requirement is that a company be one of the largest non-financial businesses listed on the NASDAQ. Over the last decade and a half, that happened to put it in the middle of one of the greatest runs large-cap technology companies have ever had. The rule didn't predict that outcome, it simply captured it. There's a limitation to that approach though, and a rule based on where a stock trades has no mechanism to follow leadership somewhere else. If the next decade belongs to companies listed on the New York Stock Exchange, or to healthcare, industrials, or financials, QQQ doesn't adapt. It continues owning whatever is largest on the NASDAQ. SCHG's approach is different. Its growth screen evaluates companies across the entire U.S. large cap market, regardless of which exchange they trade on. If leadership shifts, the index has a mechanism to follow, but only once a year during its annual reconstitution. And that's really the lesson from this comparison. If what you want is the 100 largest non-financial companies listed on the NASDAQ, weighted by size, then QQQ and QQQM do exactly what they were designed to do. If what you want is a portfolio built from a defined set of growth characteristics applied across the entire U.S. market, including healthcare companies, payment networks, industrials, and financials that QQQ can never own, that's exactly what SCHG was built to provide. Over the period we tested, these funds fell by roughly the same amount, recovered on roughly the same timetable, and spent most of their lives moving in the same direction. The biggest difference wasn't the ride, it was the passengers. I want to hear from you on this one. If you own SCHG, QQQ, or QQQM, tell me which one you chose and what actually drove that decision. Was it the index methodology, the holdings, the performance, the lower fee, or did you just look at the chart and pick the one you trusted more? And if there's another pair of ETFs you want me to run through the same process, put both tickers in the comments. I'm building out this comparison series now, and I want the next episodes to come from the questions people are actually asking. If this video helped you understand what's really inside these funds, give it a like. And if you like rules-based investing, real data, and no hype, consider subscribing. Stay disciplined, Stay patient, and I'll see you on the next flight.